Okay, welcome back to yet another our first lesson in corporate finance. And according last time we were looking at the course outline where we were discussing what things we'll be able to cover in this course, and of course today we are beginning the beautiful introduction to our course, which is an overview, which is an overview of corporate finance, unit 1. All right, now this unit introduces you to the to the overview of corporate finance, which deals with the meaning of corporate finance, its scope, its objectives, and the tools of corporate finance. Of course, it will bring about some opinions that abound on this concept, as well as it will also point out towards financial aspects in every decision that a business person makes. Okay, there is no hard there's no hard and fast rule to the application of what corporate finance techniques. Okay, what you as a student need to understand is the concept and an extent to which the corporate finance could be of help or could be of influence to the financial management team of your organization or to your organization as manager. So our objective of in our today's class, a number. Of course, we are looking at defining and explaining the term of corporate finance, identifying the state of the scope of corporate finance, mentioning the goal of corporate finance, highlighting the tools of corporate finance. Okay. All right. Now let's dig into it. Now, main content. Let's look at this. Now, what does corporate finance mean? When you hear a person saying corporate finance, what do we mean? What is it? What is this thing that is we are dealing with? Of course, we are saying business organizations in carrying out different activities of the firm engage in transactions that mostly have financial applications. Okay, these financial transactions have to be adequately summarized to at least determine the viability of the firm in terms of profit and profit generation. The result is to prepare financial statements that would span the business lifetime. What we are trying to talk about here is that, you see, every business makes decisions, and those decisions that are being made by the manager of the business is that the ultimate goal is to make profit. Now, if the ultimate goal is to make profit, you as a corporate finance officer need to be able to make those decisions that will drive to the goal that you are looking at. Now, imagine that you were to start your business, right? No matter what type you started, you would have to answer the following questions. Okay, these are the questions that you have to answer. Now, we are talking about what long-term investments should you take on. Okay, what long investment should you take on? What lines of business would you be, and what sorts of business, buildings, machinery, equipment will you need for you to be able to achieve that objective? Okay, where will you get the long-term financing to pay for your investment? Okay, will you bring in another owner or will you borrow the money? Okay, those are decisions that you're making. Okay, now the last question is, how will you manage your everyday financial activities, such as collecting money from your customers and paying suppliers? Okay, so those are the three main questions that we will be handling in our course. Now, these are not only questions, but there are many more other ones which are very, very important. Okay, now corporate finance, broadly speaking, is the study of ways to which these three questions are handled. Okay, therefore corporate finance could then be defined as decision made by a business that affects its finances. Okay, so it is the decision that is made by an organization which affects its finances. Okay, so corporate finance, we're talking about a formal setting, a corporate, okay, a formal setting, it's a corporate, okay, a corporate finance. So we're talking about a formal setting, now it's finances. All right, so that is our simple definition. Okay, so the decisions made by a business that affects its what? Finances. Okay, now these decisions can be categorized into into investments decisions, financing decisions, and dividend decisions. So now we've got three. Okay, we are talking about investment decisions that you have to make for your business, then we've got financing decisions that you have to make for your business, as well as dividend decisions that you have to make for your business. Okay, now those are the three. All right, so in case you're asked, you should be able to know that there are three decisions that have to be made: investments, financing, and dividends. Okay, now financing itself, we're talking about the context and extent of corporate finance are determined by the type of business activities carried out by the firm. Okay, this requirement differ just organization prefer to have it. They prefer from this from organization to organizations. Okay, decisions on what business to go into rests on the shoulders of the stakeholders. So of course you need to, the stakeholders of the business are the ones that are going to give you a scope of what the materials as well as the goods to supply as for your business. Okay, the stakeholders will give you that. Of course this can be covered in other courses of your program, but of course for this program we are saying the stakeholders are the ones that are giving you decisions that you have to look at. All right, now what are the goals? What are the goals of corporate finance? Okay, now the goals of corporate finance are: one, to deal with competition. Okay, to deal with competition, and two, you are looking at to steer away, to clear out the competition. Okay, of course every business has got competition, but corporate finance prepares you to deal with what? Competition, and deal away with problems. Okay, potential financial problems. Now it is a balancing act that solves the short-term problems of today but takes into account the long-term effects of those decisions. Of course it solves, we are saying it solves the potential problem of today, but it gives you a clear stance on the long-term effects of those problems that you are encountering today. Okay, now one of the objectives of corporate finance is to maintain short-term cash flow by implementing effective accounts payable procedures, securing short-term financing, and leveraging relationships with vendors without risking the future financial health of the company. Okay, here we're looking at most of the companies, the fear of most of the companies is to run into bankruptcy. Okay, now if you are dealing, today's problem are the ones that are going to affect tomorrow's problems, and tomorrow's problems will affect the rest of your business. And the fear is that you don't have to, those problems don't have to lead into bankruptcy. You don't have to run out of cash. Okay, so you need to give, you need to have a projection, a forecast towards your future. Okay, and of course it will give you all this. Now this of course is helping you make decisions, healthy decisions for your company. Okay, now management needs to consider the long-term effects of high interest rates. Okay, for instance, we're talking about high interest rate. So as management, you need to look at the effects of high interest rates on your business. Okay, and develop a list of potential alternatives to help the company avoid taking on extra interest debts. Okay, already we know that most of the companies survive on debtors. Okay, you get money from the from this money lender, then you have to deal with interest. but of course you have to compare the levels of interest and the amounts that are given by that particular interest. Now tools, let's look at tools of corporate finance. Okay, now we're saying corporate finance involves financial and accounting decisions companies make on day-to-day basis. Okay, now to help ease the burden of bookkeeping, budgeting and reporting, there are a variety of corporate finance tools. There are a variety of corporate finance tools that you need to use for you to help your corporation control its finances, which will lead to a greater and greater efficiency for your company. All right, the objective is that you need to be efficient in making decisions. You need to make decisions that are flowing coherently for you to benefit or for a business to stand out. Now in corporate finance we have a few of those tools that will help you to do that, and amongst them we've got the present value. The present value, what is the present value? Okay, the present value is, okay, we're saying this is one of the most important tools used in corporate finance. Okay, the rule of present value states that the value of any asset is the present value of its cash flow at a discount rate. I repeat that. This decision states that the value of the assets, okay, of the company at that particular time, which is the present value, okay, is equal to its cash flow at a discount rate. Okay, at a discount rate. So we're talking about, you have a phone, right? Let's look at, you have this phone. Okay, you've got this phone. Okay, this phone, the present value of this phone today, okay, the present value of this phone today is a discounted value for tomorrow. Okay, so it comes as a discounted figures, okay, at the discount figure, which is an asset of course, but today is this amount, but tomorrow it is a discount figure. Okay, in your further studies you will learn how to calculate the present value using those tools, but in this study we want to emphasize that corporate finance relies on a simple principle in economics known as the separation principle. Now this concept states that investors will agree on a discount rate. That is very important. Every investor, every customer will agree at a discount rate, even if they have different risks aversion characteristics, provided the capital market is active in which they can invest, lead to what? Borrowing at a prevailing market rate. Okay, that's a present value. Okay, so financial statement analysis is the one of the two. Now the figures used in corporate finance are derived from financial statements. All right, it is good you understand the financial statements by now, because the prerequisite of this course is that at least you'll have done some financial financial course, financial accounting, principles of accounting. Those will give you more information about financial what we're talking about, the financial analysis statements. Okay, it is good you understand now. Okay, and now that you understand, it is going to give you the difference that exists between operating and capital expenses, and why some expenses are set off against current revenue to arrive at a net income, while others are capitalized on balance sheet and depreciated over time. Okay, it is also necessary you understand the financial ratios used by analysts. Okay, so we're going to look at all that. Now that is another financial statement, that's another tool, so which is the financial statement analysis. So this one, it gives you a propensity or a magnitude for you to be able to understand the relation in the financial statements that you have. Okay, so the third one is the risk and return. Okay, risk and return. So in this course, most of the discussion will be on the notion that investors and firms with higher risk should be compensated with higher expected returns. This then goes to explain how risk should be measured and how high the return should be for a given level of risk. Here we're just trying to say that every business that is risky has got high returns, and actually this is very realistic. When you look at most of the business that are risky, okay, are risky, have high turnovers, they have high profits. Okay, this is the principle, the risk and return. So we're talking about a more risk a business is, the more return it it gets. Okay, so that's just a general principle. You can actually find out more and be able to get it. Then the last tool that we're going to be using in this course is option pricing. Option pricing. Now, option pricing is a theory which is associated with more investments and financial markets rather than corporate finance. Okay, however, it is very critical in some aspects of corporate finance, which is specifically in investments analysis. Firms are faced with options pricing theory provide useful insight into the determination of the value of these options. Of course, we're talking about, in financing decisions, option pricing theory is useful in designing and valuing securities with embedded options such as warrants, convertible securities, and callable bonds. Okay, now we're going to talk about more of these callable bonds, warrant, the convertible securities, and other things that we'll be talking about. But here we've looked at 4 tools that are used in corporate finance, which leads to the efficiency of an organization. Of course, in concluding, we are saying that this unit has provided both an overview and a basis of what you will learn in this course material. Okay, we define corporate finance as all decisions made by business that affect its finances. These decisions are categorized into investments, okay, financing, and dividends decisions. We also noted that corporate finance has only one objective: to maximize the value of the firm. To maximize the value of the firm. So, in summary, one of the basic preposition of this unit is that it tries to broaden your mind on the big picture of corporate finance, in which all decisions and tools that would be discussed about to come together. Okay. Now, don't forget that the investment, financing, and dividend decisions are under the control of the decision makers of the firm. Okay, subject to the constraint of the marketplace. These decisions also affect the value of the firm. Okay, these decisions also affects the value of the firm. Now let's look at the what is the task today. So I'll leave you the task so that as we pick up next time, you present this task to me. So let's go on to the task. Okay, so your task is very simple today. So your task is conduct a presentation on the description of how the four discussed tools bring efficiency to the company. So of course, 4 corporate finance tools, which is the present value, financial statements analysis, risk and return, as well as option pricing. Okay, so discuss their definitions, how they are important to the company, and how they will bring efficiency to the company, and what you understand. So I want this work before our next class. Every one of us should need to be able to conduct that as a task and present it to me with given marks as given in your CA. Okay, thank you so much. Until we meet next time. Goodbye.